Meme stocks are returning. Roaringkitty led the meme stock revolution by going all in on GameStop. Hedge funds shorting GameStop to the ground were met with rabid hordes of retail traders who kept buying the stock. The frenzied buying spree of GameStop stock sent its stock price through the roof, through what is known as a short squeeze. This is when people shorting the stock are forced to buy more of the stock to cover their short positions, driving the rise in GameStop's stock price. At the end of the GameStop rally, GameStop stock was sitting at $500 per share, over 30 times its value prior to the rally. The stock's rise was never based on fundamentals, rather it was fueled by the retail traders' desire to squeeze the greedy hedge funds for profit, manipulate the manipulators at Wall Street who had been influencing the prices in the stock market for decades. It was glorious. Many retail traders made money and many also lost out on the chance to make money because their diamond hands were too strong as GameStop's rally fizzled out and its stock price plummeted back to earth. The GameStop moment triggered the birth of meme stocks. Many new meme stocks followed GameStop's entry into the Wall Street Bets Hall of Fame. Among the new guard was Nokia, BlackBerry, AMC, Hertz, and also Bed Bath & Beyond. Bed Bath & Beyond is a large retailer which sells household goods, furniture, electronics, things you would like to put in a home. Basically anything anyone would need to make the house feel like home, as well as anything extra to make life a little more tolerable. The store was everywhere and it had almost everything you could want in whatever color or style you wanted. If a large assortment of choice was what you were shopping for, it had it, hence the name Bed Bath & Beyond. Unfortunately, the company was a victim of the retail apocalypse, where shoppers went less and less to large malls and department stores, preferring to buy their stuff online through Amazon instead of wasting their time going to malls. Some big box retailers like Walmart, Target, Costco, and IKEA managed to adapt based on their value propositions, but Bed Bath & Beyond was not so lucky or competent. It went through hard times that it never recovered from. At their peak, Bed Bath & Beyond had bought out one of the largest competitors, Linen & Things, and Cost Plus World Market, which were thorns on their side because those retailers had sold similar stuff to their own. Then the unthinkable happened. Those retailers they bought started losing more money. These stores actually went out of business. Bed Bath & Beyond was losing money too. E-commerce, Walmart, and Target had taken their market share. Activist investors were barking at the gates, and Bed Bath & Beyond was the owner trembling on the front porch. Activist investors accused Bed Bath & Beyond of managing the company poorly, neglecting many of their stores, paying executives more than they should have, and making poor acquisitions of horrible retailers which went out of business so quickly shortly after their purchases. They also accused the company of paying too much money to Bed Bath & Beyond's owners. Activist investors who owned a lot of Bed Bath & Beyond shares had used their power as shareholders to kick out the company's CEO at the time and replaced him with a man called Mark Triton. Mark had been the linchpin in Target's turnaround strategy back when the retail's businesses were still suffering. Now, investors expected Mark Triton to do the same thing and fix Bed Bath & Beyond's broken business model. However, before Mark Triton could do anything more than shut down hundreds of its stores and revamp the company's e-commerce experience, tragedy struck. Many people were forced to stay within their homes. Customers were not allowed to go out to shop for fear of death. The pandemic had happened, and with it came the downfall of Bed Bath & Beyond. Customers could not shop at Bed Bath & Beyond, and so their businesses suffered, or so they thought. The opposite happened. Since the pandemic meant that people were confined to those jail cells they called home, people started investing more and more on home goods to make their homes a little more comfortable. This made sense because they were spending a lot of time at home after all. Bed Bath & Beyond, which had been suffering from declines in sales, suddenly had people buying up their home goods en masse. Bed Bath & Beyond saw its chance and grabbed onto its new lifeline, and for the first time in forever, they made a ton of money. This was a good thing, but the problem was this artificial demand would not last. The success Bed Bath & Beyond had experienced in the pandemic hid its internal problems, which were never fixed. Once the pandemic ended, there was no guarantee that customers would continue to shop at Bed Bath & Beyond like they had done so during the pandemic. So prior to pandemic reopening, Mark Triton decided to rebrand the shop. Bed Bath & Beyond had always been seen as a messy shop. It was so messy that people would get lost in it. So Mark Triton, the new CEO, decided to declutter its stores. When people came back to Bed Bath & Beyond stores, he wanted them to have an organized shopping experience. However, that didn't happen. When customers came back to shop at Bed Bath & Beyond, they did not like what they found. Shoppers had liked the old messy cluttered style of Bed Bath & Beyond, the messy piled up high to the sky goods and wide assortment of God knows what. They wanted to be overwhelmed by choice. They wanted to pile it up high and let it fly experience. But what they got was the complete opposite of those qualities that made Bed Bath & Beyond into the large big box retailer it was known for. Shoppers wanted to find many things they had never needed or wanted before and buy them anyway. But the company couldn't even do that. What's worse was Mark Triton had made one of the worst decisions in Bed Bath & Beyond's history. He had reduced Bed Bath & Beyond's product selection. All of those national brands that shoppers loved were gone. In their place were some private label brands that Bed Bath & Beyond had made itself through factories in China that no one cared about. The supply chain problems also meant the company couldn't get their new private label brands onto store shelves fast enough, so plenty of Bed Bath & Beyond shelves were just empty. This frustrated shoppers. They didn't like the generic low-quality stuff that Bed Bath & Beyond had ordered from their manufacturers in China. Most products nowadays are manufactured in China, but what makes it different is the brand. The brand doesn't grow overnight. They have to be cultivated, and customers have brand loyalty built into their core. They have specific go-to national brands that they already want and expect Bed Bath & Beyond to have. So when Bed Bath & Beyond replaced those well-known brands with nonsense generic brands that the company made out of thin air, customers balked and didn't buy them. Mark Triton had made a bet using his hallmark private label brand strategy he had honed back in his days as a Target executive, and he had failed. Private label brands may be more profitable, but cutting out the middleman wholesalers doesn't matter when no one is buying those brands. He was too busy trying to turn around the company that he had neglected to set up logistics for his new private label strategy. Private label goods need a lot of work. Target, Macy's, and Walmart had to spend years doing product research, setting up teams, designing, setting up warehouses, logistics systems, and plenty of other things before spending tons of money marketing their private label products to consumers. Bed Bath & Beyond did none of that. Mark Triton had created too many private label brands and started putting them up for sale too quickly. Traditional retailers like Costco's and Macy's had large distribution centers up and running, sending goods to their stores nationwide. Bed Bath & Beyond, on the other hand, had to ask their vendors to send it to their shop directly for them. Customers couldn't find what they were looking for in Bed Bath & Beyond and went to shop elsewhere. Bed Bath & Beyond used to have everything, and now they had nothing. As a result, their businesses are in decline, and their operations are draining it out of money quickly. In February of 2022, Bed Bath & Beyond had over $440 million in cash reserves, but by the end of May the same year, Bed Bath & Beyond had only $100 million in cash reserves. That's a net loss of $350 million in the past quarter. That's 4 consecutive quarterly losses in a row. The activist investors had had enough. They made the board of directors fire Mark Triton because of this, replacing him with an interim CEO called Sue Gove. Bed Bath & Beyond are now trying to raise money to support their operations. The company is projected to lose even more money, almost $200 million worth, by the end of August. And if its suppliers lose faith in its ability to pay out, then they could lower their payment window, forcing Bed Bath & Beyond to pay within a month rather than 2. This has the effect of raising the money Bed Bath & Beyond would need to continue operations. It is also why the company is looking for a $375 million loan to continue operating its stores. There are some rumors that Bed Bath & Beyond may go bankrupt after people found out that it hired a law firm which specialized in company restructuring. Bed Bath & Beyond is shutting down many of its private label brands that it recently introduced. However, its plans to return to its past business model is in tatters. Now that Bed Bath & Beyond doesn't have enough money left, it will be hard to work with vendors of a national brand, as they may now ask for advance payments before delivering the goods, as there are fears of Bed Bath & Beyond going bankrupt. So what's been happening with Bed Bath & Beyond stock? Well, it's been doing poorly. It has become a meme stock. The reason it became a meme stock was actually because of a man called Ryan Cohen. Ryan Cohen had been one of the investors of Bed Bath & Beyond. So who is Ryan Cohen and why is he important? Ryan Cohen was a co-founder of a pet goods company, Chewy, and he was the one who bought a ton of GameStop stock. Retail traders had hoped that Cohen would improve GameStop's struggling finances and jumped into the stock after Papa Cohen dived in. This sent GameStop's stock price to the moon. Cohen became one of the key figures which brought about GameStop's rise. So when people found out that Ryan Cohen had spent over $119 million in shares and spent over $1.7 million on call options at the strike price of $60, $75, and $80 respectively, they went crazy and piled into Bed Bath & Beyond. Call options gave the buyer the right but not the obligation to buy the underlying stock at a certain strike price. Bed Bath & Beyond stock price would have to reach over $60, $75, or $80 a share if Cohen wanted to make money using those call options. So when Wall Street bets and retail traders saw this. They believed that Bed Bath & Beyond would reach over $80 eventually. Who better to trust than the person who was involved heavily with the greatest meme stock of all time? Ryan Cohen was the chairman of GameStop, and this added to his credibility. Bed Bath & Beyond had all the hallmarks of a meme stock. It had a lot of short interest, over 50% of it at one point, useful for short squeeze. It was a recognizable brand, so many people knew about it, and it had a prominent investor backing it, aka the chairman of GameStop, Ryan Cohen. In March 2022, Ryan Cohen revealed that he was the proud owner of over 10% of Bed Bath & Beyond shares. He also wrote a letter to Bed Bath & Beyond through his company, RCC Ventures, citing concerns about the company's decision to fix itself. Ryan Cohen believed those measures weren't working and criticized the top brass for taking high compensations for their underperformance. He also advised the retailer to go private and to sell Bye Bye Baby, one of Bed Bath & Beyond's core assets. Ryan Cohen also announced that he wanted to sell his Bed Bath & Beyond shares. Bed Bath & Beyond had been losing traction. Bed Bath & Beyond stock had been dropping, reflecting the lack of confidence that investors had in the company. Then something magical happened. Bed Bath & Beyond rallied. It went from $5.70 to a high of $28 a share at one point. That's a roughly 500% rise in the stock. So in August 17, 2022, when people found out that Ryan had filed a notice to sell his 10% stake in the meme stock by filing a Form 144 with the SEC, people panicked. However, the Form 144 gave Cohen the right to sell, but did not mean that he had sold anything yet. So people were still hopeful. They thought that Cohen filed the Form 144 because he owned over 10% of a company and so was forced to file if he wanted to sell the stock within the next 90 days. Surely he wouldn't sell the stock. He was the chairman of GameStop, and that meant he was an ape. It was Ryan Cohen who had triggered Wall Street Bet's interest in Bed Bath & Beyond, and it was his intention to sell the shares which triggered the meme stock's downfall to $8.70 a share. Unfortunately for retail traders of Bed Bath & Beyond, Ryan Cohen did sell the stock. Cohen sold Bed Bath & Beyond at a probable closing price of between $18 to $29 a share, far from the lofty $80 a share that retail traders were expecting based on Ryan Cohen's call option plays. When people found out that Ryan Cohen had sold his shares, tons of them exited the stock as well, so Bed Bath & Beyond stock price fell. The stock prices of AMD and GameStop also fell in parallel to the drop of Bed Bath & Beyond stock price. Ryan Cohen got $68 million in profit, a 56% return on investment, while the average retail investor got nothing. There was one retail investor which profited greatly and was able to time the markets before Ryan Cohen sold out of his Bed Bath & Beyond shares. Jake Freeman, a 20-year-old college kid, managed to make over $110 million through his Bed Bath & Beyond shares before the stock price tanked. His timing was so great that he sold the meme stock 24 hours before the Ryan Cohen sell-off sent the stock price tumbling to the ground. Jake Freeman had actually started a company called Freeman Capital Management with a small loan of $25 million from family, friends, and his rich uncle, and he had used the money to buy over 5 million Bed Bath & Beyond shares. This meant he had owned over 6% of Bed Bath & Beyond before he pressed the sell button on his Interactive Brokers and TD Ameritrade accounts to exit his position at $27 a share, netting him that $110 million in profit. Jake Freeman admitted that his win was a fluke, and he had planned to hold the stock for at least 6 months, but sold it once he saw how crazy the Bed Bath & Beyond rally was. The reason he bought Bed Bath & Beyond was because he felt it was priced with expectations of bankruptcy. So he reasoned if the company heads fixed the business, the stock would go up. In his Reddit post ode to Bed Bath & Beyond, he said he was going to miss being the second largest institutional investor in Bed Bath & Beyond and was planning on going to Bed Bath & Beyond to shop tomorrow. The comment section of the Reddit post, on the other hand, were extremely salty about Jake Freeman's win and called him a paper-handed bitch. So what now? Some Bed Bath & Beyond investors are still positive about the stock, and many believe the sell-off has renewed their conviction for their long-term view of the stock. However, many are still unhappy about the turn of events, because the way they see it, someone had to lose money to make Ryan Cohen richer. The casino is over.